Hello, I'm Damit Patmalal. I'm the Chief Investment Officer at Nabo Capital. And here I watch over all of our asset classes, which range from money market instruments, which we are quite well known for, and then in terms of increasing risk, bonds and equities. Thank you for the question. So at Nabo, we deploy what's called the special situations or event-driven investment strategy on top of our investment philosophy, which includes the 4 Ps and 4 Cs. I won't go into the latter because I think we've talked about it a lot, but I want to spend some time just defining what special situations are. And this is, I promise, the only time we're ever going to go into jargon. Special situations are any event that causes the price of a security, whether it be an equity or a bond, to become dislocated with its long-term cash flows or the market. What this allows us to do is create returns for our clients despite what's going on in markets. So one thing we can attribute Nabo's very strong track record to over the last 3 to 4 years is that special situations overlay. So whether the market's up or down, we can find a winner, and that generates consistent returns for our clients. Policy changes all the time, I think. And one thing that's beneficial for us when I mention special situations is that what's happening now in global markets is a special situation by definition. So there's a lot of uncertainty that's been brought in by certain policies and escalating tensions between global powers. How do you play in that? You have to find those securities that are not connected with the overall trend in markets. From the perspective of somebody who either invests short-term or long-term, there are additional strategies you can use. If you are a very, very long-term investor, you could theoretically buy what people call the dip. I wouldn't advise this because there's so much uncertainty right now that we're facing an era of what's called economic decoupling. There's a power center in the east and there's a power center in the west, and from what I've been seeing, it certainly looks like we're going to shift from the previous paradigm of free trade and integrated markets and supply chains to a new regime. What is that regime? The jury's still out. I think we'll find out more in the coming days and weeks. Yeah, absolutely. I think, I touched on special situations before, but another strategy we use at Nabo is opportunistic credit. And what's interesting about this strategy is that when I think we first came up with it, nobody believed that you could create equity-like returns in bonds. But over the last 3 years, our opportunistic credit strategy has generated a little over 50% in returns in USD, which is equity-like and it's quite good. Just want to stay humble when I say that. Thank you. I think that's an excellent question. If you don't have a strategy, you're just being reactive. And the more reactive you become, the less likely you are to make good long-term decisions. So the key thing about having a rigid strategy and how it helps out is that it helps you navigate these patches of uncertainty by knowing what the long-term game plan is. The other way to put it is, I think, strategies do help, but it's always important not to become overconfident on anything. One thing that trips a lot of investors up is that, yes, they have a long-term strategy, but they don't have sometimes tactics to navigate these markets. So strategy and tactics, I think, really help people navigate these markets. And of course, I would want to say something about the opposite side of it, which is well said by Mike Tyson. Everybody has a plan until they get punched in the face. So strategies help, tactics help, but being nimble and humble allows you to adapt quickly. I think one of the biggest mistakes investors make is a lack of consistency. What separates the amateurs from professionals is consistency. When you check in at office, let's call it 9 a.m., you have to put your game face on. And you have to realize that you have a fiduciary duty to your clients. So whatever is going on personally can't trip you up. I think that's one really big mistake I've seen investors make. The other big mistake I've seen investors make is that they put too much weight on a data point, one number. So let me give you an example, right? So right now, markets are wrapped in turmoil because of shifting policy. There's two ways to identify this, right, as a root cause. You could say this is policy uncertainty, but from the investor's perspective, this is a reflection of a lot of investors putting too much weight on one data point. GDP growth is going to go up, up, up. Inflation is coming down. These are two examples of putting too much weight on data points. And let me just bring this home to Africa and Kenya especially. Kenya's expected GDP growth rate was around 5.2%, give or take, for this year and next year, depending on which economist you ask. When you take into account what's happened with the cutback in aid, certain Kenyan African sovereigns like Uganda, aid constitutes more than 3.5% of their GDP. With the Central African, the CAD and other sovereigns, it constitutes more than 10%. This means that those countries could face not just a recession, but a depression. And that is a huge mistake folks make, being overconfident. How do you navigate that? Be nimble, I think, and be humble. No one's smarter than all of us, so having a wide world view helps. And I always say, teamwork makes a dream work. Sorry for the slip up. So really being open to being the idea that you are not the only person who knows everything helps you mitigate these downside events. I would say that it's good to be worried. Macroeconomics are really what drives your return in asset classes, how companies do, how countries do. My own personal experience as a Sri Lankan, right? I think when I was leaving Sri Lanka, I was the only person that in my professional circle, was really worried about Sri Lanka defaulting. And Sri Lanka defaulted due to number of reasons, but fundamentally it came down to economics. The country was just borrowing more than it can reasonably grow at. So this is just a little bit of theory I'm going to throw in there. People think debt gets a bad reputation, but debt is how really most economies work. And you can borrow as long as you can borrow at a rate that's lower than your long-term GDP growth. So that's how you kind of stay out of defaulting. That's also how you avoid a debt trap. Of course, there's other nuances. So in short, for the folks who are worried about the macroeconomic environment, I would say you're on the right track. So that's a great question. So I'm going to do a little bit of a dodge and weave on this. While I am a long-term investor, I'm a closet medium-term investor. And the reason I want to say this is because the way you get to the long term is through the medium term. And if your medium term is really, really, really bad, you're never going to get to the long term. And there have been other better expressions of this where, in the long term, you're dead. So the focus to short term, I think, however, is an issue because we've been moving towards a world where people want to know things now. People want things next day, maybe even the next minute. And we've been globally creating this culture where if you don't have the answer right now, where you don't have the return right now, you're somehow inherently flawed and you're somehow inherently weak. And what it's led to is some really, really bad decision making, right? So I would say it's okay to stay focused on short term, as long as you can find a way to navigate to the medium term, and your 3 or 2 first step, your 3 to 4 aggregates of your medium term will get you to the long term, and that's how you really do it. The problem with just being too focused on short term is that you cannot distinguish between white noise, pink noise, and actual information. That's a good question. What I can tell you with 100% certainty is that it will affect global markets. There's a rising power in the East, and there is somewhat of a declining power in the West. And the way folks should really navigate this is understand that there's 2 rising powers, and for especially smaller nations, I feel, not bet all your money on black and see how it pans out. Whether black means east or west, doesn't matter. I think what really is important is balance. The other thing that's happening with this escalation is that we're seeing so much innovation coming out from China, and you must give China due credit for what's happening there. Probably the best electrical car charging that's come out lately. BYD is able to charge their batteries just about as fast as petroleum. And of course, the DeepSeek and the rise of cheaper AI agents. This is really important for smaller countries such as Kenya, of course, and even middle-income countries, because the amount of capex required by the American model, That's really only available for hyperscalers like the Mag 7. And that's not really something that can work, I think, in less rich countries because the capex requirement is just so low. So I think the way to really untangle this is one step at a time and just really balance your options and not be too polarized on whether it's east or west. I'll end this with an anecdote that from my grandfather. My grandfather was just a common guy, but he was very well respected in his town. So whenever there was an election, politicians would come to his house to seek approval. And the understanding is that, if my grandfather backed politician X, he has a better chance of winning the election in that small town or city. Well, definitely small town, sorry. And this is what he did. When he had an appointment with one party, he would put up that candidate's portrait on his front entrance. And then when he leaves, he'll take it down. When the next candidate comes up, he'll put up the next candidate's listing. What did this allow him to do? It allowed him to keep friends with everybody. I'm not giving advice on such an extreme example, but I would say that the mark of a true politician or a great human being is the ability to be a friend to one person without being an enemy to another. So that's how I really see navigating this change in economic orders, which is going to be our reality for the next 40 to 50 years. You can't walk away from it. Yeah, a parting shot would be, I think, consistency. Consistency. Don't fall into the trap of thinking that you're the smartest person in the room. If you're the smartest person in the room, my advice to you is leave the room. And of course, dream work makes a team work. And that due diligence you put up by, being prepared for every possible scenario will help you navigate these uncertain times and get you from this short-term to your long-term goals.